Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Market Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, to discuss the top performing asset in 2021 and why 2022 could be the return to more normal economic data. Phil, it's great to see you. Happy New Year. Welcome back to Trade Talks.
Thanks, Jill. It's good to be back, and hopefully it's not a repeat of last year. It feels a bit that way with COVID running, but I think things might end up being different by the end of this year.
Before we get to 2022, let's talk about 2021. It might not be that much of a surprise, but tell us about the best performing asset and why.
Yeah, so if we look at sort of classic investment theme assets, commodities were really the strongest performers, which isn't a surprise given all we talked about last year with the stimulus driving the manufacturing recovery and everybody buying stuff. And obviously stuff needs to be made of commodities. So that was the best performing, but equities weren't far behind, especially US equities. And really, if you look across the spectrum, that's about the only assets that outperformed inflation. So investing in bonds, a lot of the time had negative returns, well behind inflation. A lot of emerging markets had negative returns. It was a pretty tough year for investors, unless you're in commodities or US equities.
And the market recovered to near all-time highs to kick off the year despite Omicron raging around the globe. What's different this time around with COVID?
Yeah, so I mean, that's really the crux of what the markets at least think of the data that we're seeing for COVID so far. And we've seen, I guess, the South African result now for 6 weeks. If we look at the US data, we're following the same track as South Africa. The new COVID cases are off the charts. I mean, the 1 million cases a day is way above the high levels that we saw last year, but we still aren't seeing an increase in hospitalizations. We're not seeing an increase in deaths. We're not really even seeing an increase in the ICU wards. And that's pretty consistent across the world. So, you know, the globe has seen a huge spike in COVID cases to record levels, but they haven't seen deaths come through yet. It's a little early on the deaths because we know that they lag by 3 or 4 weeks. They always have. But if we look at South Africa, which is at least 3 or 4 weeks ahead of us, they've found that the death rate really didn't change that significantly. They also found that the probability of getting COVID badly enough to go to hospital was about 20% compared to prior variants. And if you ended up in hospital, you had a lower chance of ending up with serious disease anyway. So really the risks of Omicron are significantly lower than the risks of all of the previous COVID variants that we've had.
And although today's headlines with Omicron make it sound like 2021 all over again, you think 2022 might actually be different as it relates to underlying demand. Why is that?
Yeah, I mean, the markets obviously have bounced back. So they're pricing in the fact that they think this wave of COVID is a sign that it's becoming less virulent and less dangerous. They're obviously saying that we don't think we're going to see company shutdowns and revenue shutdowns. So that's going to pivot us from looking at things like whether airlines have mass cancellations and hotels lose bookings and people stop going to restaurants, and starting to focus on the bigger picture and what's really going on at a company level. And we've started to see already a little bit of a slowdown in some of the manufacturing sector. We've seen some of the supply chain bottlenecks starting to clear. We've seen some of the delivery times clearing out and coming back down towards normal because of that. And most importantly, we've seen the costs of some of those inputs into manufacturing starting to fall. And typically that means we'll probably start to see inflation come down a little bit, at least, to some of the pressure on inflation. And obviously that's important for rates, which is important for stock valuations. So, you know, we're starting to look at some of the more, I guess, corporate and fundamental data to see where the economy is going to go for the rest of this year.
All right. Phil, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.